It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today I thought I'd talk about some of the recent discussions, questions that I have had regarding your personal bank with some recent folks I've spoke with recently who are longtime radio listeners. They've been listening to the show for a while and had situations that were interesting. So let's just dive right in. How's that? So again, for those of you that are not familiar, your personal bank is really quite simple. We set up a high cash value policy. The idea is to earn dividends. This is not how most people view or use life insurance. It's to grow cash, earn dividends. And we can do that on a guaranteed basis with, tax favored, grow the money tax free, access it tax free, pass it on to your heirs, income tax free if it's set up correctly, which of course we do. And then the next step is set up a bank line of credit. And when you do access the funds, obviously if you leave them in the policy to earn dividends, you earn dividends. And like I said, we have companies that have been around since before the Civil War, never missed a dividend all these years. We have companies that are paying 5.75 to 6% dividends. Even today, never paid less than that the last 25 plus years. And if you listen to one of the previous shows recently, one of the companies actually has come out and stated they're going to continue with that 5.75 dividend for next year, 2022 that is, and probably for the year after that. And, with this low interest rate environment, by the way, that's powerful for a company to come out and commit to that level of dividend a year or two out forward. So that's pretty impressive. And then again, the next step is we set up a bank line of credit. So when you do access the funds, you access them from the bank line instead of from the insurance policy. And we have banks that are charging between 3 and 3.95% interest. So I asked a simple question. If you're earning 5.75 to 6% dividends, which are current rates, and on the low end historically, by the way, and then you access the funds and you're getting charged in the 3 to 3.95 range, what's your money doing for you? Well, again, the answer is quite obvious. It's still earning. You're keeping the difference, which is positive arbitrage. All right. So I had these folks I spoke to just a few days ago. Very interesting. They actually sold a house recently, bought a new one, downsized, had some proceeds. Interestingly, moved from a blue state to a red state, and the cost of living was lower. Go figure, right? And taxes and everything else. But anyway, that's a whole nother discussion. My point is they had received some proceeds from the sale. And what was interesting, like these one folks are planning to build a pool house and do all this kind of stuff. And so they want to use probably half of the funds that they received and build this pool house and whatever. But listening to the show said, we've got this chunk of money. We're going to use some of it to build the pool. But wouldn't it be nice to earn some interest on it, earn some positive arbitrage, and build the pool? And the answer is, of course it is. So my point is really quite simple. When you're purchasing items, paying off debt, investing, again, I say this all the time. You have the choice. And you have some funds you're going to allocate to that. You can invest that money. You can pay off the debt. You can purchase items like a pool, like this with a pool house. Or you can put it in a personal bank policy, earn dividends, access the funds from the bank line. The dividends you're earning is more than the interest you're getting charged, so you keep the difference and still go build the pool house, the pool and the pool house, right? Or pay off the debt, or invest, or whatever it is you want to do with the money. And pick up, in their case, it's going to be about 2.5% positive arbitrage, which frankly is the average. That's the most common amount I have folks receive. Most folks receive between 2 and 3% positive arbitrage. And that is true long term, by the way, not just now. That's a question I get quite often, but historically. And I've got charts that have been sent to me by some of the companies that show that the positive arbitrage scenario has been in place every single month for the last 40 years, except for 2 months. And in those 2 months, it happened to be equal. So even the long-term historicals on this positive arbitrage scenario, has been there in the last 40 years. And that includes, obviously, low, medium, and high interest rate environments. So that's pretty awesome, frankly. So again, the point is, why not pick up the positive arbitrage? Look, they received the funds from the proceeds from this house sale, right? That happened. They're planning to take about half that money and build a pool and a pool house. They're going to do that. Most people, what they do is they then just take that money and build that pool, right? And the thing is, there's nothing wrong with that per se. I mean, they're getting a pool out of it and a pool house and all that, which is nice. But most people take that money and do that, obviously that money's gone forever. It's out of your control. You gave it to the pool contractor, right, to build the pool. And the reality is, once those dollars are gone, they're out of your hand, out of your control, those dollars never have an opportunity to earn or grow for you ever again the rest of your life. And if you take a situation like these folks where it's 2.5% positive arbitrage, and like I said, historically that's been the case, so let's assume that continues going forward, how much more money are they going to have, just using this one simple example? And by the way, the pool and the pool house and all that's probably going to be around $100,000 for them. Okay. Well, that's $2,500 interest, positive arbitrage in 1 year. That may not sound like a lot of money, but think about this a minute. That positive arbitrage is going to continue every single year for the rest of their life. In a decade, that'd be $25,000 basically. That's without compounding, right? That'd be an extra $25,000. In 20 years, that'd be an extra $50,000. You see, my point is, would you rather take your money and buy a pool and a pool house? And like another situation happened not too long ago. I had a client, they're buying an RV, by the way, similar situation, around $100,000 they were spending. Would you rather buy an RV or a pool house or a car or any other item? It doesn't matter what the item is, folks. Or invest $100,000 into an investment or an asset, or pay off bills. Would you rather pay off the bills, invest in the asset, or buy the item and have the item or the asset or the bill gone? Or would you rather take those dollars, pay off the bill, purchase the asset, purchase the item, whatever it may be, and pick up interest every year for the rest of your life? In their case, without compounding, if they live 40 years, which, by the way, with the age of these folks I was talking about, is highly likely, they're going to get us back in interest without compounding the entire $100,000, assuming current positive arbitrage rates continue, like I said, as they have for the past 40 years. If that happens the next 40, what about spending the 100, building the pool, and in the next 40 years get $100,000 back in positive arbitrage, which frankly, in their case, as in most folks' case, that's just extra money. That's found dollars, extra dollars that they would not have seen any other way. Because remember, folks, these people are planning to build the pool anyway. Whether before they talk to me, they're going to do it. If they do talk to me, don't talk to me, doesn't matter. They're going to build that pool and spend that money, right? Well, here's the thing to understand. We all spend money. It costs money to live, right? Food, clothing, housing, whatever, right? It's one of those things you just don't get away from. So my point is simple. You're spending money anyway. Pretty much every single one of us, unless, somebody else is supporting us perhaps, but just about everybody listening to me right now is spending money every single day, every single week, every single month, every single year of your life. And those dollars you're spending on whatever it is, food, clothing, housing, items, debt, assets, whatever that may be, it doesn't matter. Whatever you're spending that money on, once you spend those dollars, they're gone, right? Just like I shared with these folks with buying or building the pool. And you can either have that item, have that asset, and have that investment, whatever it may be, or you can have that item, asset, or whatever it is, and pick up some interest along the way on the dollars you spent. I guess what I'm trying to get at is the big takeaway. And this is the thing I share with people, well, every single time I meet with them. And I shared it with these folks with the pool also. I said, look, if there's one thing I want you to remember from our discussion, what's the big takeaway? And I'm going to tell you that also right here. The big takeaway from this whole idea of the personal bank concept and how it all works, it's quite simple. And this is it. The big takeaway is that positive arbitrage, that interest you earn, the difference between the dividends you're getting paid and the interest you're getting charged. Folks, that positive arbitrage, that interest, that money you're earning is on dollars you spent. I'm going to say it one more time. The interest, the positive arbitrage, the money that you keep, the difference of the dividends paid versus interest charged is on dollars spent. Money you spent, you gave away, you traded out for an item or whatever. They're no longer in your control. They're no longer in your pocket. And if you take dollars to purchase an asset, that's the same thing. Though that money is no longer in your control right now, right? You don't have it in your bank account or your wallet or anything anywhere else. It's gone. And once it's gone, typically it's gone forever, right? Sure, you can invest in an asset can increase in value. I understand that. But the dollars you use to purchase that asset are gone forever, aren't they? Why not take those dollars? That's all I'm saying. Why not take those dollars and purchase that asset or investment if that's what you want to do, but also gain some positive arbitrage from it? Why is that so important? I shared it earlier in this segment. And if you missed it, go to yourpersonalbank.com, and you can go back to listen to any of the previously recorded shows, by the way, or if you missed this, you want to go back to it. But the thing is, that extra interest, those extra dollars in your pocket means your money goes farther. It means you have more of it. Who couldn't use more money in their pocket, right? Who couldn't have more of their money work for them, even if they used it to invest or whatever, but even work even further. Double duty, so to speak. Get double duty out of your money. And look, folks, I'm going to talk about this in the next segment, so I'm going to encourage you really to stay tuned. You know, if inflation does continue to increase, as many experts believe it will, getting your money to do double duty and work more harder for you is going to become increasingly important as we go forward. So stay tuned in the next segment. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And like I said, we're really talking about some recent questions that I had from prospective folks who've been, radio listeners for quite some time and are interested in starting a personal bank policy process. And like I said, in their case, they had received some proceeds from a house sale, planning to purchase, actually build a pool and a pool house and all that, and take some of the money and do that. And like they said, like the husband said to me, he goes, I sure like the idea of picking up positive arbitrage interest on this money we're spending on the pool anyway. Like I said, they're going to do this. They're building this pool whether, we do anything or not. They were planning to do that on their own. And they understood from listening to the show, which I think is awesome. That's really one of the big reasons I'm doing the show, is to educate folks, to help them understand that, look, you can make your money go farther. You can make it do double duty, still work for you even after you spend it, for example, building a pool or anything else for that matter. And I want investors to understand, because here's something I think a lot of investors miss. See, most of the time, not always, but a lot of the times when I meet with investors, they focus on rate of return. And what I find is, generally speaking, they focus on rate of return, well, almost exclusively. Don't pay much attention to most other things. We all know there's other things that are important. I think it was Will Rogers or one of those cowboys who said, the return of my money is far more important than the return on my money. I'm paraphrasing, but he's right. Risk. certainly has a very strong, or should be a very strong consideration on any investment. Obviously, the rate of return is important, of course. What's the tax consequences? Obviously, is a big one. Should be a big one. What's the liquidity, penalty, restrictions, early access, and those kinds of things are obvious questions on any type of investment. But like I said, I find, generally speaking, many investors focus on the rate of return, well, almost exclusively. And that's fine. I mean, like I said, you should look at the other stuff too. But what I have tried to do, and been successful in doing, I guess, to a great degree, is helping those investors understand, look, you can increase your rate of return by using your personal bank. And again, the way to do it, how to do it is quite simple. Picking up that positive arbitrage, I tell people all the time, it will make the difference. It will add an extra, like I said, for most people, 2 to 3% annual positive arbitrage. Most of our folks are getting 2.5%. That's the norm. That's the average. And again, that's long-term historicals too, by the way. But again, if you add 2.5% positive arbitrage, for example, to any investment out there, just about, you are significantly increasing your rate of return, are you not? I mean, if you're getting a 10% rate of return on an investment, and most folks, I think, would agree that's pretty strong. That's good. By adding 2.5% to that rate of return, you go from a 10% to a 12.5%. Look, those of you that understand annual returns, those of you that understand compounding and understand numbers, know that small little difference of 2.5% makes a huge difference in your actual returns because of compounding, especially if you can do that over a decade or two or longer, right? So my point is, I say this all the time, look, I'm not here to dissuade you from investing in something that you want to invest in, that's something that's your thing, so to speak. You've had success with it or something you want to do. If you ask my opinion on things, of course, I've got a lot of experience with that myself personally and working with clients for well over 20 years now. But my point is, if you have something that's working for you, I'm not the one that's going to tell you to stop doing it. I'm going to tell you keep going if it works, right? I don't care what it is. The only thing I'm going to encourage you to do is consider using your personal bank in addition to it. Because what you can do is you can add that positive arbitrage. And whether your rate of return is 7 or 10 or even 20% a year, I mean, that would be an incredible rate of return. I think most would agree. Well, by adding another 2.5%, let's say, to that, you've added another, 10% greater. You've enhanced your returns by 10% further. You see what I'm trying to say? 2.5% for 10% is like a 25, what is it? Yeah, 25% increase, right? Over what you're already doing. You see what I'm trying to say? That's a lot more. And if you compound that over a period of time, and additionally, you can throw in the tax benefits that your personal bank can offer, you will end up with significantly more money in your pocket using this tool versus not. I mean, and I can say that with all confidence because, well, if you add, like this client, prospective client I spoke to this week said, look, if the positive arbitrage is anything over 0, that's extra money to me in my pocket. I said, exactly. So when I say you're going to have more money, if you have a positive arbitrage situation, anything over 0, you're going to have more money. It's mathematical, right? So frankly, to not use, playing the devil's advocate here, let's say you don't apply this tool to your investing strategy. Well, frankly, you're just giving up. You're giving up interest. You're giving up money. You're giving up rate of return. To not consider it seems kind of foolish, right? So, like I said, if you're interested in more information, by all means, contact me at yourpersonalbank.com. Be happy to share with you how this can work for you. And again, increase your rate of return. My point is very simple. Positive arbitrage is your friend. It gets your money to work for you, double duty, right? The dollars like I said in the last segment, the dollars that you used and spent or allocated elsewhere or used to invest in another asset are still working for you, still earning interest. You're gaining the difference. So the bottom line is quite simple. Your bottom line will be better. You will have an increased bottom line, more return. It's kind of funny. It's like some people ask me, well, how can that be? Again, the answer is really quite simple. These insurance companies have been paying these dividends for years and years and years, decades even, some since before the Civil War, literally since before the Civil War, never missed a dividend ever. And I said in the last time, we got companies that have committed to the 5.75 rate or above already into 2022 and stating that for 2023 in this lower interest rate environment. And that's really, really powerful. And like I said, in this low interest rate environment, of course, bank lines are very low. And you can keep the deposit of arbitrage. Like I said, don't forget, historically, this has been the case too over the past 40 plus years. So this is not a new idea. It's not a new concept. It's not smoke and mirrors. It's not, it's just most people are not aware of it or not familiar. And that's another one of those questions that I get, obviously, quite often is, well, why have I heard about this elsewhere? Why aren't other advisors talking about it and that kind of thing? Which I guess I'll hit on that in the next segment. So I'm going to encourage you to stay tuned, and I'll share with some of the reasons why you haven't heard about this concept or this idea, even though it's been around for decades and decades and very widely used in the institutional markets, bank boards and corporate finance boards and family offices and things like that. For more information, contact me at toll-free 866-268-4422 or yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. I'm talking about today some questions I've received recently from a radio listener who's probably going to become a new personal bank client. If you missed some of the previous discussion, talking about what to do with, they're planning to receive some proceeds from a house sale, and they're going to take some of the money and invest it, actually shouldn't say invest it, build a pool house and a pool, and still receive positive arbitrage on that money they're going to allocate to build the pool, which is really cool. That's one of the really neat things that the personal bank can do, which puts a lot more money in their pocket, keeps those dollars that they have, they're in control right now, continue to earn interest for them, despite going ahead and giving them to the pool contractor, right? But one of the other questions they asked, and I get this going quite often, he said, he goes, this it's pretty straightforward. See, it makes sense. He goes, I'm always looking for positive arbitrage scenarios. Anything over zero means you got more money in your pocket. And I said, exactly. And that's just a good thing. And he pointed out, he said, I've looked into over the years of many, many different things, heard about a lot of different ideas and concepts and various things. But he goes, the problem with most of them I've run into is they end up being a negative arbitrage situation. In other words, it ends up costing more than what you're making. And I said, yeah, that's a common problem. He says, you've been able to find a way to create positive arbitrage. And I said, exactly. And that's in long term. And that's what's so exciting about it. Again, folks are making 2 to 3% positive arbitrage right now. 2.5% is the average. And historically it's been so. So that's pretty awesome, frankly. But then, like he said, he goes, it's not that complicated. It makes sense. Why aren't more people talking about this? Why aren't more people familiar with this? More advisors discussing it? And, I get asked that so often, and there's no one single answer to that. There's several reasons behind it. Probably the most common is that most advisors, most people, are just not introduced to the idea in the first place. I know I wasn't. I was doing annuities and IRAs and 401ks, retirement planning, things like that for years. Gosh, well over a decade. And before I learned about this, I was no slouch. I was one of the top 10 producers in the country, for example, with one of the top 2 companies in the country dealing with these kinds of plans. And I was not aware of it. Never been approached of it. Nobody I talked to brought it to my attention. When I got into some different areas, and particularly in the banking arena and stuff, where it's much more common, bank boards deal with this all the time, positive arbitrage. I mean, that's what banking is all about, folks. Banks are built on positive arbitrage. I mean, that's how they make their money. And I think most people can agree that banks are financially savvy. I mean, banks know how to make money, right? Most of them do. And they've known how to do that for a very, very long time, centuries, literally. And what I'm trying to say is that financial savvy that they have, we can certainly learn from that. So bank boards deal with this all the time, using policies for positive arbitrage, taking those funds, loaning them out, deposits, things like that. I mean, that's how they make their money. They charge more interest than they pay, right? I mean, think about it a minute. Even today, it's really not that complicated. If you're going to get a house loan or a car loan today, I mean, a house loan, you get good credit, you can get in the 3% range, right? A car loan, probably 4 or 5% with good credit. What are banks paying interest rate with checking accounts, savings accounts, CDs, all those kinds of things? Most cases, less than 1%, right? So if they're paying less than 1 and they're charging 3, 4, 5% even, and if higher risk loans are higher interest than that, well, aren't they keeping the difference? The answer is, of course they are. That's how a bank makes its money. That's how banks operate. Now, there's some other things they do, but I'm simplifying things here for a bit. But it's obvious how that's the primary source of earning how they make a profit. You can do the same thing. And so it's not that it's a complicated concept by any stretch. It's just something people don't think about, don't deal with, unless they get into the world of banking, right, which I was fortunate to do, or corporate finance boards or family offices, which typically are, it's an investor or group of investors with over 10 million liquid in assets, things like that. When you get into those institutional investor environments, this is actually quite common. It's just not common in the retail world or the retail investor world, which frankly is most people, right? So the advisors they're not taught or trained that. They're not familiar with that. That's not the world they're dealing with. And so I guess it's a need to know basis. I don't know. There's just no reason to teach those folks something they don't need to know, right? And so that's why most people in most cases have not been introduced to this idea. There's some other reasons behind it I'll get into, I guess, in the next segment because we're coming up on a hard break. But as I always say, if you were interested in more information, contact me at yourpersonalbank.com or toll free 866-268-4422.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Well, like I said, I've been talking about some recent questions that I get these quite commonly, by the way, when I speak to folks one-on-one, when they contact me, and, most of the time they've been listening to the show for a while, got a gist of the idea, like the idea of the positive arbitrage, like the idea of reducing taxes, like the idea of reducing market risk, increasing rate of return, increasing liquidity, maximizing income, getting your money to do double duty for you, work more than it is now, so your money goes farther. All those are all, really good reasons that folks, look into this idea and are interested. It's kind of funny. I get a lot of the same questions when we first, chat, and I've shared with some of those earlier in this show. So if you did miss it, go to yourpersonalbank.com. You can listen to any of the previously recorded shows anytime you like. Of course, you can contact me for more information there, or toll free 866-268-4422. I was kind of leading, and if you missed it, go back, like I said. But some of the other reasons why people are not so familiar with this, and like I said, there is a difference in the financial world in terms of what's known as, many of you heard of this, the institutional investor versus the retail market or the retail investor. And, there's banks and large hedge funds and, we know, there's pension funds, all types of different institutional type investors, corporate finance boards, things like that deal with, large amounts of money. A family office is generally, rule of thumb, 10 million liquid in assets or larger. Many times quite a bit larger than that, frankly. And that's one world, right? And then there's the one that most of us are familiar with, actually, much more familiar with, and that's in the Wall Street calls the retail world. And that's, that's CNBC and all these different, all these different things that are out there, and all the different brokerage firms and financial firms and mutual funds and, all these different investments, annuities, and everything else that's out there, bank investments, whatever. That's the retail world. That's where most people reside. And that's the arena that most advisors reside, because that's where their clientele is. That's their experience level, their knowledge base, and who they deal with. So again, one of the main reasons the question I get is why didn't I hear about this? Why aren't I more familiar with it? It's just, most financial advisors focus on the retail market. That's who they work with. Most of us folks don't deal with folks with, with people with over 10 million, 100 million in liquid assets. It's far less common, right, than the average American, right? So it's not brought to our attention. Like I told you, I wasn't aware of this for well over a decade myself in my own career. And I was one of the top producers in business. I wasn't out there doing a lot of business. It's just working with a lot of clients. Just was not in that world. And when I got into the banking stuff, that world, then that started to change. And so my passion focus here with this show has really been to educate people, to bring their attention to this idea and realize, hey, look, and when I was first brought this idea to my attention, look, there's another way. There's a better way. There's a way you can enhance your returns, make your money go farther, all those things. And I even said, I remember talking to the instructors when I was first introduced to this idea and going up to them and asking them, you keep talking about like working, they were talking about working a lot in the medical market, working with a lot of doctors and stuff. There's many physicians and high net worth individuals that do use this tool. It's quite common. And I said, you keep talking about the doctor who makes $500,000 a year and, those kinds of things. Why do you keep referring to that? And, what about the person who's out there making 50 or 100 grand a year, let's say? Would this work? And they're like, of course it would. And I said, well, why do you keep referring to that only? I said, well, first, that was their niche. That was their market. And secondly, as they pointed out, from an advisor standpoint, it takes about the same amount of time to work with a client that's, earning $500,000 a year versus a client's earning $50,000 a year to set up, educate, set up the account, and do all the things that need to be done. And obviously, for a case that's 10 times bigger, it's 10 times the income, commission, whatever, to the advisor, which naturally makes sense. I mean, that's logical, right? So their decision, their focus was to just focus on that market, just strictly from a financial standpoint and a time standpoint, which I totally understand. In fact, many of us, know this. There's many investor groups, investor firms, whatever, that will even advertise, if you have $500K or more, contact us for information, kind of thing. So what they're telling you in a nice way, basically, is that they really want to focus on people with, say, $500K in liquid assets or more. And it's not that their services they offer or whatever it is wouldn't benefit the person with less than $500K, for example. It's just it's a time and cost of doing business, all that kind of stuff. And so they've just chosen from their standpoint, from their business standpoint, that that's what makes sense for them. And that's where a lot of it comes from, frankly. So I was fortunate. I was in a little bit different situation. We, as a company, I've shared this before, we had upwards of 4,000 clients by then, which is quite a large number for any kind of financial agency whatsoever. We had been fortunate in doing a lot of those dinner seminars and things like that, and brought on a lot of clients over a period of, well over a decade. And when I was introduced to this idea, we're meeting with most of these clients on a, annual review basis kind of thing anyway. And I thought, how hard would it be to introduce a new idea to our clients who are meeting with anyway? So it wasn't like we had to spend extra money or time or anything else like that to generate this. We were meeting with these folks anyway. And obviously, when we showed the positive arbitrage, reducing taxes, increasing liquidity, getting your money to work for you, double duty, reducing taxes. I don't know if I said that earlier. By the way, there's a long-term care benefit built in, so a lot of people like that. There's no additional cost there's money available for long-term care type of expenses if you need them. I say, look, if you need it, great, you got it. And if you don't, you didn't pay extra for it, so what can be better than that? There's a death benefit involved, even though our focus is to grow cash and maximize dividends and all. There still is a death benefit, so if something happens prematurely, your loved ones, there's typically a big check for them. So when you put all those things together, frankly, our clients loved it. And what happened very quickly was they started saying, I've always been good at referrals, generating referral business. That's been a big key to success. My attitude has always been, look, if you take care of somebody, they'll take care of you. I've lived that way. I've taught my agents and trained them over the years. Look, take care of the folks, they'll take care of you. And it's been very true. I've been very successful as a result. And you know what I'm saying. I always have had a lot of referral business throughout my entire career. But this idea was off the charts. I would meet with somebody, talk to them, share with them this idea, and even without asking, in most cases, they say, look, you need to talk to my brother, my cousin, my business partner, my whatever. They were volunteering referrals to me even before I would ask for them in most cases. And that's when I quickly realized we're really on to something here. And that quickly led into, as I've shared before, speaking engagements. And then I started speaking all over the country about 7 years ago, give or take. I've been everywhere from Seattle to Chicago to LA to, Dallas, everywhere in between. Okay. And then, then the radio thing came up because of the speaking, right? I was hesitant to do this initially, to be fair. And the reason I was hesitant to do this show, to share this idea, was it was really about the time commitment, because understand at the time we had a lot of clients doing a lot of reviews, still do, of course. I was traveling around the country speaking to investor groups, and I was thinking, how in the world am I going to fit this in my schedule? And so it really was about how was I going to make it work? Because, there's just so many hours in a day, right? And I do have a family and a life, and I wanted to not destroy all of that, So I agreed to do it because I was able to do it without investing a lot of time, extra time, I should say. But more importantly, it was really about reaching out to a whole new audience. And, the passion I had from the very beginning about this personal bank concept, knowing the average investor, the average individual, average American was not familiar with this. So it became a mission to share this idea and get it out there to people so that they, would be aware of it and could, take advantage of this and improve their financial situation. So the radio gave me the opportunity to open this broadly to a whole new audience and quite a large audience, frankly, not only in Phoenix, where I'm located, but frankly, across the country. I'm amazed at the reach that the radio has, particularly with online. I have clients literally from coast to coast. I've had a lot of clients all over the country, but now it's literally coast to coast. I guess my point is, why don't more people know about it? I guess that was the question I was trying to get at, and I kind of got into my story a little. So, but, and I'll say this. The last thing I want to say on this is I became very fortunate because I started the radio about a year roughly prior to COVID, the COVID stuff happening. And obviously, all the speaking engagements disappeared, right? So the radio replaced all of the speaking, and I didn't have to travel all over the country. So I quickly found out, hey, this is a really nice way to get the message out, to be able to pursue my passion of educating people about this idea, show them how to improve their financial situation without having to hop on a plane and fly over the place all the time. And I'm actually reaching out a much broader audience. So when people say, why haven't I heard about this, or why more people, I'm doing my part. Okay, I'm doing the best I know how to do to get the message out there, and I'm standing on the corner banging my drum and being as loud as possible, if you know what I'm trying to say, and just trying to help people understand, look, there is another option. Actually, you can add this to whatever you're already doing. It doesn't take away from whatever you're doing. So don't make the mistake. And this is one mistake I see investors in particular make. They're like, well, I'm investing in this, and this is working out okay for me, so I'm going to stick with it. You can do that, of course, but that's not the best way to operate with your money, especially if you can pick up positive arbitrage, which means you can keep doing what you're doing. If you've got an investment that's working, like I said, keep doing it. By all means, keep doing it. But you can increase it. It's like icing on the cake is what I'm trying to say. You can enhance what you're doing, increase your rate of return. Look, keep doing what you're doing, man. If it's working, keep doing it, right? But add to it. Increase your rate of return. Add some additional benefits, some tax benefits, reduce some market risk, increase liquidity, all those things. And keep doing what you're doing, but now enhance it. Increase your rate of return by, say, 2.5%. And again, like I said at the very beginning of this show, if your rate of return is 10% a year, and I believe most people would agree, and that was your average over long term, most people would agree that that's pretty strong. And if you could increase that to 12.5, just do the numbers. Just do a little bit of math, and you'll quickly figure out that, holy cow, that extra 2.5%, it's an extra 25. That's a 25% increase on your rate of return. That is huge, and I don't care how you measure it. You add that up year after year and compound that, holy cow, that turns into something big time. So contact me at 866-268-4422 or yourpersonalbank.com for more information. And let me show you how we can really enhance your financial future and make a tremendous difference.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.